Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Wednesday. These are the stories that set your agenda. Treasuries rally after private sector data signals a cooling US labour market, spurring traders to boost bets on a Fed rate cut. AMD advances, Nvidia's nearest rival in AI chips, says it sees 5 years of accelerating growth driven by data centre demand. We're watching as well from tech earnings from Haldea and Infineon. Plus, UK Prime Minister Keir Starmer said to face a leadership plot from within his own cabinet as internal feuds spill into the open just 2 weeks ahead of the budget. So it was a mixed picture on Wall Street yesterday, with the Nasdaq 100 ending a little lower by about 0.3%. The S&P just notching out some very modest gains. And of course, we do expect further progress potentially on ending that US government shutdown. And that could happen as soon as today. The European session yesterday, very strong, a fresh record high led by the healthcare sector. Gains of more than 1% for the Stoxx 600. And today looking to build on that then. Futures pointing higher on the Stoxx 50 futures by about 0.3%. Again, on the back of a fresh record high for European stocks yesterday. Here in the UK, FTSE 100 futures currently unchanged. S&P E-minis pointing to gains of 0.2% after the very modest upside of yesterday. Nasdaq 100 futures looking to add 106 points, looking a little brighter, up 0.4% after a little bit of softness yesterday. Nvidia closing lower in the session. AMD, though, pre-market, pre-open, is looking strong on the back of that upgrade around forecast. Let's flip the board and have a look cross asset. Treasuries have been bid and continue to be bid on the back of that softer private sector data in terms of the labour market of the US. Concerns there, but that is leading to increased bets that the Fed will cut in December, an almost 70% chance being priced by the markets, and that is leading money into the Treasury markets with yields down 3 basis points on the US benchmark 10-year at 4.08. Euro-dollar at 1.15, largely unchanged on the single currency. Brent at 64, close to $65 a barrel. Interesting and important updates coming through from OPEC and the IEA on the oil markets today, currently down 0.4%, and gold still above 4,100, but facing a little bit of pressure in the session today, down 0.5%. Let's cross over to Asia right now, check in with Winnie Su in terms of how the Asian markets are faring this Wednesday. Joining us from Hong Kong. Winnie, what are you looking at?
Morning, Tom. It is quite a risk-on session in Asia today. In fact, you can see the MSCI Asia is up for a third day. Now, overall, stocks in South Korea, in Hong Kong, and Japan are all gaining on that optimism for the end of the U.S. government shutdown. And also, as you mentioned earlier, that soft jobs data fueling bets for the Federal Reserve to cut rates in December. Now, we want to highlight here also the Japanese yen, because we are seeing a bit of a strength coming through for the U.S. dollar, which is also pressuring the yen here. In fact, it has weakened today against all G10 peers and now is at its weakest level against the dollar since February. So just right below that 155 psychological level that we are closely watching. Now flip the board and take a look at this interesting stock that we would like to highlight today, which is SoftBank. And the stock actually tanked about as much as 10% earlier today. It had that better than expected earnings from second quarter, but it actually sold all of its stake in Nvidia, which also fueled some more concerns around the tech valuation. Now, interestingly, we are seeing that they are paring some of its losses and now just down about 4%. Analysts have been telling us that it is actually for some investors a good timing to buy, as they are expecting the AI-driven growth for SoftBank to just get started. Now, sticking with Japan, we take a look at what's going on with the broader indexes, because there is that interesting trend that we are seeing once we take a look at this chart. So actually today we are seeing the broader topics index outperforming the tech-heavy Nikkei 225 in the green here, and that is mainly driven by that tech rotation. rotating away from tech and into defensives. And it is quite a sharp reversal from what we have been seeing, where we saw Nikkei 225 really outperforming topics for the past few weeks on that tech rally. So that interesting rotation is happening as we see further concerns around that lofty valuation for technology shares and investors looking into other opportunities outside of tech. Back to you, Tom.
OK, Winnie Su in Hong Kong, thank you very much indeed. Treasuries then rallying, as I mentioned, after private measures of US economic data pointed to a stumbling jobs market, spurring traders to boost wages that the Federal Reserve will cut interest rates next month. Let's bring in Bloomberg's Valerie Teitel right now. So, Valerie, another example of bad news is good news for the Treasury markets, for the equity space as well. A big rally in Treasuries on the back of this data around jobs.
Yeah, it was interesting. This is the ADP weekly data set. This is a relatively new data set that they are releasing in the absence of that government data. But yesterday, the data release had really pushed back on this idea that the labor market is stabilizing. Again, it was another piece of evidence that this weakening labor market in the U.S. remains intact. The data showed that in the last 4 weeks to October 25th, the U.S. economy has shed on average 11,000 jobs per week. Now, there are some objections and caveats to this data set. As I mentioned, it's a relatively new data set, so economists don't really have a lot of backward-looking data or trends in order to follow that. And also, the government shutdown might be affecting this data set. We know that it's kind of complicating and altering data at the moment. Now, the interesting thing about this, though, is yesterday we also had some pretty disappointing data when it came to small business optimism that declined yet again, a dip in confidence amid concerns about labor quality. So again, the labor story really tying into business confidence here. Small businesses also saw declining sales and demand. And this is important because small businesses are one of the biggest employers of the U.S. labor force. Now, we have to also tie this into the other data that we have gotten from the BLS, which is the CPI report. That was really the one piece of data that we had gotten in the shutdown, not necessarily showing any concerns that inflation is on a rising track, but again, is still painfully above the Fed's 2% target.
Well, as you talk about the shutdown, and we may get an end to that as soon as the end of today, of course, if it passes the House and gets to the President's desk in time, how is that likely to read across into thinking around the Fed, particularly when we get that additional data?
Yeah, so a lot of the developments in Washington are going to be impactful for the Fed's decision on December 10th. If we do get the House voting on the shutdown bill today, which is looking likely given we're seeing the current debate of the House Rules Committee is now voting to advance the funding bill to be voted on later today. If we do get that, we have 4 weeks, Tom, until the Fed convenes. So that means that the Bureau of Labor Statistics has 4 weeks to clear this backlog of data that really can be key here. If they do get out most of that data, that could be something that the Fed could act quite powerfully on. But if they're still behind by December 10th, perhaps the Federal Reserve will be less keen to have a big pivot either in a dovish or hawkish direction, given they're still waiting for this clarity on data. Powell said it himself in the press conference last week that because they have this cloud of uncertainty, that essentially doesn't mean that they should still be continuing on a cutting path, but they should be essentially pausing until they get more clarity on this data fog. The other thing that we should watch in Washington later today is the fact that Trump has invited Wall Street bosses to dinner tonight. We have news that in attendance will be the CEOs of JP Morgan, of BlackRock, Goldman Sachs, and Morgan Stanley. Now, Trump has used these dinners in the past in order to get people on his side for his agenda. Perhaps we could see more political pressure being amped up on the Fed if he does want to get Wall Street bosses, at least on his side, in calling for steeper rate cuts from the Federal Reserve.
Valerie Teitel, thank you very much indeed. Yeah, we'll look to that dinner and see what comes out of that as well. Some breaking lines right now when it comes to the Dutch lender ABN AMRO. And the redhead is that it will be buying NIBC Bank from Blackstone for around 960 million euros, so just shy of 1 billion euros for this transaction. NIBC Bank is a commercial bank in the Netherlands offering corporate and retail banking products. So that's the headline coming through from ABN AMRO, a stock to watch then at the open with deal making in focus. Now to the UK. Bloomberg has learned that allies of Keir Starmer have privately accused UK Health Secretary Wes Streeting of plotting to replace the Prime Minister. For more on this palace intrigue, I'm joined by Bloomberg's Lizzie Burden. Lizzie, what do we know at this point?
Well, we have to thank our UK political editor Alex Wickham for this scoop. And it's not the first time that Wes Streeting's name has been mentioned. He's younger than Starmer at 42. He's seen as charismatic. He's from a council estate in East London. He's gay. He'd be seen as a fresher face for the party than Starmer, who, of course, is languishing in the polls behind Reform UK's Nigel Farage. And don't forget, Streeting has flirted with disloyalty before. He's openly criticised President Trump around the time of his state visit, so breaking with Starmer's softly approach. But this time, Starmer's team say the market wouldn't like it. Streeting's team say it's categorically untrue. What's interesting about Streeting is that he just won his seat at the last election by a razor-thin margin, 528 seats. And so there's even a question whether he'll be re-elected when there is an election again. But the timing, Tom, is crucial. The Chancellor expected to raise taxes, break the manifesto at the budget on the 26th of November. That could be an opportunity for a leadership challenge because it would be so unpopular. But clearly, if Starmer goes so soon into his premiership, it'd smack of that instability under the Conservatives, under Johnson, Truss and Sunak, that Starmer promised he'd end.
And that brings us to the vulnerability of the gilt markets in that kind of scenario. OK, so we watched developments on that front. The economic data and the focus yesterday, of course, was the unemployment rate ticking up to 5%, the highest level since COVID here in the UK. But today, a bit of scrutiny from some, a little bit of pushback as to just how valid that data is. It's not the first time we've had question marks over the validity of UK data.
Indeed, and you've got to take... I said this to you yesterday, didn't I? You've got to take this labour force survey with a wheelbarrow full of salt. And indeed, the Bank of England official Megan Green has reminded us that that is the case here. When we got that unemployment figure, of course, opposition politicians seized on it, but traders as well, upping their bets of a Christmas cut from the Bank of England. And indeed, JP Morgan changed its call from seeing a cut in February and bringing that forward to December. But Megan Green warning about these data collection issues. Just remember, the Chancellor's last budget was accused of being part of the reason for this squeeze on employers because she raised the payroll tax, of course. Megan Green says, actually, if you look at the high-frequency data, that squeeze, the brunt of it, is behind us. OK, Lizzie Burden, thank you very much indeed. UK correspondent, of course, on the pressures on the Prime Minister and the economic data. Question marks there, of course, as unemployment reached 5% yesterday. Here's what else to think about then in the day ahead. 6:30 a.m. UK time, so we're counting down to this, a little under 20 minutes away. We will bring you the earnings from Infineon. We'll break those for you at 6:40 a.m. UK time. We'll bring you the interview with the CFO of that company. The stock is up about 9% year to date. Question marks, of course, about any recovery in the chip space when it comes to autos and industrial sector and whether or not we're finally finding a bottom. So that is an important interview for us today as well. And later this morning, we'll get Hon-Hai earnings. That will be another gauge in terms of the AI momentum, of course, but particularly smartphones and the exposure to Apple, how much demand is filtering through for Hon-Hai Foxconn. Today as well, we'll also get a gauge on the health of the oil market. It's a big day for the oil market in terms of reports coming through from the IEA and oil in focus, of course, with OPEC as well. The OPEC monthly oil report will be dropping later today. Brent under a little bit of pressure in the session today, down 0.3%, just shy of $65 a barrel. You can get a roundup of the stories you need to know to get your Wednesday going in today's edition of Daybreak. Terminal subscribers can go to DayBgo on the terminal, and that potential leadership challenge here in the UK is in the spotlight. Coming up with the end in sight, we'll be discussing the financial impact that the US shutdown is having on that economy with the global head of Raymond James's private capital advisory. And later in the show, we're going to speak to Adyen after the company forecasts better than expected growth after 2026. Our exclusive interview with the Dutch payment platform's co-CEO is coming up at 6:30 a.m. UK time. Stay with us for that. This is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Let's bring you some earnings out of Asia right now with the global impact, of course, and the global footprint. Hon Hai, third quarter net income in Taiwanese dollars coming in above estimates and comfortably so at 57, close to 58 billion Taiwanese dollars. The estimates had been for close to 51 billion. So it's a comfortable beat in the third quarter net income for Hon Hai, of course, the maker of Apple iPhones, Samsung as well, but also data center kit and AI kit. Hon Hai seeing 2025 full-year revenue growing year-on-year. They see fourth quarter revenue growing year-on-year as well. Third quarter earnings per share, a solid beat as well at 4.15, 4 Taiwanese dollars and 15 cents. The estimates had been for around 3.7. And so it is a decent beat. Third quarter operating profit, also a solid beat for Hon Hai at 70.5 billion Taiwanese dollars. The estimates had been for 63 billion. So it's a solid beat in terms of operating profit, in terms of revenue and earnings per share for Hon Hai. It's another touch, really, in terms of the demand, not just for smartphones and Apple, but also some of that AI kit and hardware going into data centers. So that is a stock to continue to monitor as well. The stock is up about 40% year to date. Now, a record-setting, back to the macro picture now, a record-setting US government shutdown is on a path to end as soon as today, after the Senate passed a temporary funding measure backed by a group of 8 centrist Democrats. Reopening the government now depends on the Republican-controlled House. To look at the financial impact, Sinha Haldea, Global Head of Private Capital Advisory at Raymond James, joins me now. Sinha, so we know all about the data that hasn't been coming through as a result of this shutdown. If the shutdown ends, it looks very likely it's going to end this week. Whether it ends today is another question. Just get us up to speed in terms of the economic impact that this shutdown has had and how that's led to any adjustments in terms of your outlook for this US economy.
Yes, I think there's near-term impact and there's longer-term impact. The near-term impact, of course, being an impact on demand because of furloughed federal workers. Certain sectors like travel have been hit particularly hard. Now, the theory goes that as long as these are shorter-lived shutdowns, which this one very much isn't, that there will be a bounce back. But the longer this shutdown has gone on, the longer the bounce back will take, and it will not be as complete as it could have been if it had been shorter. So what does that mean? That if someone who was furloughed was going to buy an oven, they're going to buy the oven anyway because back pay is then paid out, and they'll spend it, but they'll spend it a few months from now. Hence the bounce back theory. However, there will be an impact that is not clawbackable, for example, in the travel sector, for those that have had a downward adjustment to their outlooks as households will not do the complete spending in the next couple of quarters. On average, we expect 1 to 1.5% of impact to GDP in the fourth quarter in the US. Now, there will be about 7 to 10 billion, looking at the estimates of overall demand, but keep it under context. It's a $30 trillion economy. So it will be a blip that will get made up over time. But the question is, how long will it take to get made up? OK, so it's a time frame question and it's a blip. But if you tie it together with consumer sentiment that seems to be eroding in the US, and at least on the private sector level, the private data that we have around the jobs market, seeming pressure there as well. You tie it all together. How vulnerable is this US economy looking right now? Well, that's the big question facing the Fed, and it's very split in that decision, as you know, between the hawks and the doves, those that think that labor markets should trump any kind of inflation sentiment, and those who believe and have seen in the data, the last released data, that energy, food and non-household services are all stickier on the inflation side than anybody would like. And that's the struggle here between, is the labor market picture that you're quoting here, is that a supply-driven issue because of immigration crackdown, or is it a demand-driven issue? And there are policy hawks on each side that will have a very different take. On balance, I do think that there's one more rate cut due. Is that December? Is that January? I think time will tell. On balance, it looks likely to be December, but you can't be sure now because of the blackout of information. OK, so even December is looking uncertain for you, though. You think that when push comes to shove, December is the month they go versus January. Where does that leave your views on the Fed and its rate-cutting cycle into 2026, then? I think very much a mixed picture. I do believe that there's enough of a cohort that believes that we're at neutral rate because of the inflation picture. The inflation story remains persistent at 3+ percentage points, which is a little too high for the Fed's comfort.
We're at 4% now, but you
We're
think
at
there
4% now.
are FOMC officials who think we're at or very close to the neutral rate?
Yes, at the 1 year, 3 year, 5 year outlook are all above 3%, which is too high for comfort. As you know, we're nearly 4% when you look at it today. And I do think that those officials that believe that inflation trumps labor markets will very much say that while we might do one more rate cut at maximum, the governance policies will be very high for any further rate cuts, which makes 2026 very difficult. I think it's a toss-up for December. I think on balance, they'll go in December because of some of the pressures in the labor market being the last set of data that they have on hand. But it's unclear what happens in 26 now.
Sunaina, as you well know, there's increased scrutiny. I want to move on to AI now. Increased scrutiny about the incredible spend on AI infrastructure, but also the fact that hyperscalers are increasingly tapping the public markets and the private markets to raise capital to fund that. Given your lens on those markets, the credit markets, how much of a concern is this for you? What are you seeing? What are the potential ramifications of this?
Well, I think that finally the market is taking a breath and saying, what is the ROI profile of all of this spend and how much risk is being taken, especially in the debt markets? The bondholders are now waking up to the fact that there may not be a payback on this investment in the near term. So then the question becomes, who is borrowing and at what levels to see what kind of risk you have. If it is the Mag 7 or some of these hyperscalers that are public, and they have the cash flows to back it up, you're okay. But I think in the private markets, they're taking a longer view, as they always need to do. But in general, you have to say this, and this is a bet that you're making. When you look at the Russell 3000, earnings up 11%, some of the highest growth in earnings that you've seen since the COVID era. So I think the balance sheets and the P&L profiles of most companies look healthy that haven't been able to go all in like the Mag 7 and the tech stocks. But there is a bond market question now as to how much borrowing has taken place and what is the payback return here.
OK, so there is that scrutiny, but the hyperscalers have the balance sheets, at least to reassure. I want to zoom back out to the UK. We had the jobs data yesterday. We've now got a potential leadership challenge for the Prime Minister. How vulnerable are the gilt markets as we lead up to November the 26th and the budget? What would the gilt market reaction be if we did get a real leadership challenge here?
I think it would be havoc in the gilt markets. I think the pound is likely to get hammered in one way or the other, depending on what the outlook is for that challenge. But I think that we are all expecting a really rough budget and a really rough pound hit, and therefore a gilt market that reflects that in the coming weeks. If the leadership challenge poses any risks to how the budget is going to unfold and whether it's a credible budget that gives the bond markets breathing room for the foreseeable future and as much certainty as one can get out of these policy pictures, then you're going to get some stability there. But if there is a challenge, if that's real, as Lizzie was saying, we're going to be in trouble here.
Sunaina, thank you very much indeed. Always appreciate your insights. Sunaina Sinha, Haldea, Global Head of Private Capital Advisory at Raymond James. Coming up, German chip company Infineon is set to report earnings this hour. We're going to hear from the CFO, Sven Schneider, shortly. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some of the stories making the news this Wednesday. The US military is exploring whether to build a temporary base near the Gaza Strip. Bloomberg understands the Navy is seeking a cost estimate for a temporary self-sustaining military base capable of supporting 10,000 personnel and providing office space for 12 months. And deadly explosions in the capitals of India and Pakistan within 24 hours of each other have killed at least 20 people. The explosion is in Islamabad, involved a suicide bomber blowing himself up outside a crowded court building. That followed Monday's car explosion near New Delhi's historic Red Fort. Pakistan accuses India of backing terrorist attacks, but India's foreign ministry calls those allegations baseless and unfounded. The incidents have raised concerns of renewed tensions between the nuclear-armed neighbours. And China's cybersecurity agency has accused the US government of stealing $13 billion worth of Bitcoin. The theft in 2020 was one of the largest crypto heists in history. The Chinese agency says it was probably a state-level hacker operation led by the US. Washington has said the tokens are associated with a Cambodian businessman charged with wire fraud and money laundering. Coming up, we're going to speak to Adyen after the company forecasts better than expected growth after 2026. Our exclusive interview with the co-CEOs coming up next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Treasuries rally after private sector data signals a cooling US labour market, spurring traders to boost bets on a Fed rate cut. AMD forecasts 5 years of accelerating growth on data-centre demand. This is Haldea reports a beat on net income for the third quarter. Plus, UK Prime Minister Keir Starmer said to face a leadership plot from within his own cabinet as internal feuds spill into the open just 2 weeks ahead of the budget. Let's get to the earnings story and back to technology right now. Infineon, the German-listed chipmaker, missing on first quarter revenue, coming in at 3.6 billion euros in the first quarter. The estimates had been for 3.75 billion. So this is a miss in the first quarter for Infineon, and it suggests that we have not yet met the bottom when it comes to demand, of course, for chips used in the auto sector and in the industrial space. In terms of the fourth quarter revenue, that came in at 3.94. So the fourth quarter numbers coming in higher than the estimates, marginally so. The estimates have been for 3.9, but it's the forecast into the first quarter, seeing the first quarter revenue coming in slightly softer than the estimates. That is the redhead. The first quarter, though, revenues, the fourth quarter revenues coming in slightly higher than the estimates. It's the look ahead to the first quarter that may be a concern for investors. We're going to be speaking to the CFO of that company, Sven Schneider, at 6:40 a.m. UK time. So that's Infineon. We're going to switch focus right now to the chemicals and drug space with Bayer numbers dropping as well. Let me pull those up for you. In terms of third quarter adjusted earnings, it is a decent beat in the third quarter for Bayer. Earnings, EBITDA, coming in at 1.5 billion euros. The estimates have been for 1.3, just shy of 1.3 billion. So it's a solid beat in terms of adjusted EBITDA for the third quarter for Bayer. Adjusted margins, also a decent beat. 15.6% is the margin. The estimates have been for 13.2%. This stock is up 42% year to date. We're looking for any details in terms of the performance around their prostate cancer drug, a potential seasonal weakness around the crop sciences business. But in terms of the margin and the adjusted earnings, both a beat for Bayer in the third quarter. Let's get to the broader markets right now. We had softer labour market data ramping up the bets then, or leading to a ramp up in bets in terms of the Fed, and expectations now that the Fed will cut in December. At least almost a 70% chance priced in by these markets on the back of private sector labour data out of the US that did point to softness yesterday. We do expect the shutdown to end, of course, in the US. It could happen as soon as today. That bill goes to the House, so we're watching for that vote as well. European futures pointing to the gains of 0.3% after a fresh record high for European stocks yesterday. The FTSE 100 currently unchanged in terms of the futures picture, 9,937. S&P E-minis looking to build on very modest gains for the S&P 500 yesterday, and the Nasdaq also pointing higher. The benchmark US 10-year at 4.08, yields down 3 basis points, so the bid for Treasuries continues. 1.15 on euro dollar. Brent just shy of $65 a barrel, down 0.3. And gold a little weaker as well, down 0.3% on the yellow metal. Let's get to a big player in terms of the financial and fintech space. Shares in Adyen, one of the biggest gainers of Europe's Stocks 600 yesterday, after the Dutch payment company set long-term guidance for about 20% net sales growth in years after 2026. Its co-CEO, Ingo Uytdehaage, joins me now for an exclusive conversation. Ingo, thank you for your time. Let's start with that raise in terms of the growth forecasts for Adyen from you and the team to about 2020, for about 20% after 2026. What is supporting, what is backing that view, Ingo?
Yeah, so we talked with our investors yesterday about the building blocks, how we see our business growing in the coming years. And that has not really changed compared to previous years. So most of our growth comes from our existing customer group, where we see a lot of traction in gaining share of wallet. But also the investments that we have made in the recent years in our sales teams start to pay off. So if you look at the 2025 cohort of new sales, has been bigger than years before. And that, of course, is a also a good stepping point for the years to come and the growth that we expect. On top of that, we've been making investments in our financial products, and also they will start to contribute to our net revenue growth going forward. So that gives us the comfort to give this longer term perspective. And at the same time, we also want to give like yearly guidance updates on how we look at our revenue growth in more detail.
If there was one part of the revenue growth story that you were keen to emphasise in terms of your excitement and the opportunities you look into next year, where would that be?
Yeah, so if you, of course, where I'm always most excited about is our existing customer group, because they bring the majority of our growth. It's about 80% of our growth. But of course, we're also always excited about new products. If you see at how platform pillar is performing and where financial products is going to change this whole industry, that's where we are more really excited about. This is a long-term play, so this is not just next year's growth, it's more like the next 5 to 10 years. But it will be a very important contributor to our growth going forward.
How do you see AI agents transforming and reshaping commerce, Ingo?
Yeah, so I think if you look at agentic commerce, I think one of the most important things is that we make sure that we put merchants in control as AI enters commerce. I think it's one of the biggest concerns of our merchants that they potentially are left out of the equation. And we're working together with all the big players in the fields to make sure that the new protocols make sure that the shopper relationship is protected. So we are very upbeat about it, but of course it's in a really early stage. So it's more like a longer term development that we expect. Of course, internally, we're already using AI agents. If you think, for instance, about how the number of AML alerts are being handled in our company, we're using AI agents with that together with the dynamic identification foundation that we have in our company, where we basically have a layer that brings context to those agents, and they can handle these alerts basically in seconds, where humans would take about 30 minutes to complete these evaluations.
Yeah, so that's important, particularly when we think about the risks around fraud and how AI might be empowering that. Ingo, how far are we away from a world where we have AI agents who will find and make purchases on our behalf?
Yeah, I think we're entering that stage. I think, of course, the question is, what are the industries that will adapt it first? I think for apparel or for travel, these are things that are, I think, relatively here in a short notice. But it really has to take off still. So it is in the early stages, and we expect that it will take off. I think 2026 is going to be an important year here to see how it exactly develops. But if you look at the total payments volume also on our platform, it will still be relatively limited. That's my expectation, at least. It's more a long-term development.
And Ingo, I want to switch focus a little bit. We have a question from one of our viewers asking how you're looking at and how you're judging the European ecosystem right now and some of the legacy companies out there, and whether or not you see maybe some acquisition targets or opportunities to make some acquisitions or make some moves.
Yeah, so if you look at the industry, there are a lot of legacy players, but I think one of the strengths of our company is that we have a single tech stack. So we've always grown our platform organically, and that means that we don't have to work with multiple platforms. That's also one of the reasons why I expect that we won't be part of a consolidation game on the payment side. We will continue to invest in our organic growth and making sure that we help our customers in the best way with building new technology on top of our current platform. That has always been the strategy, and let's see what is happening around us. But I think if we talk to our customers, most important thing is that we continue to bring innovation. And innovation is only possible if you're quite strict on the platform that we have. And it's also one of the strengths. Like if you think about what we can do with our dynamic identification, basically we turn every transaction into a proof of trust. I think that's a key thing. And that's only possible because we have that single platform. So all transactions are run through this single system, and therefore we can make better predictions. And that becomes more difficult if you have multiple systems.
Okay, that makes sense, and the fact that it sounds like you're going to be staying on the sidelines if consolidation does step up. Look, you obviously have a touch point. The business has a touch point on consumers and businesses globally. What are you seeing in terms of, we had up the holiday season and into 2026? How much resilience are we seeing or not amongst consumers? We're seeing some evidence that things are slowing down in the US. What are you seeing from your customers and clients and consumers?
Yeah, so in general, if you look at our numbers, it's not really visible things are slowing down. I think if you look at our Q3 numbers, we're growing still faster than the market. That's also captured in our forward-looking guidance. So a 20% growth is more than market growth. So in that sense, I can't really comment on what we expect for the organic growth of our customers. I think so far we haven't seen any slowdown, but the season has still to come. So we will track it closely in the next couple of weeks.
And just briefly, you're obviously listed in Europe. You're listed in the Netherlands. Ingo, have you and the team ever had any discussions about a dual listing in the US or any concerns about being publicly listed in Europe, given some of the question marks about the capital markets of Europe?
Yeah, so if you look at our listing in Amsterdam, that works really well. Like, we have the investors that we like to have, also a lot of US-based investors. So it's not a limitation. Of course, we always look at what are potential next steps. But so far, it hasn't really come up that it's needed to move to the US. We have sufficient liquidity in the stock, which of course is a key thing. We have the right investors that are supporting our long-term strategy. So from that perspective, we are very happy with our listing in the Netherlands.
Okay, Ingo, thank you very much indeed for your time on a busy week for you and the team, of course, with the Capital Markets Day yesterday, the upgrade to the forecast. Ingo Uytdehaage, co-CEO of Adyen. Now back to the story around Infineon. Bloomberg's Guy Johnson has been speaking to the CFO of that chip maker, Sven Schneider. He asked if 2026 is the year the German chip company becomes an AI stock.
If you look into the revenue development for AI, and for us, AI is powering AI from grid to core, has developed in a very steep way. 2 years ago, it was 250 million revenue. Last fiscal year, more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5 billion. So we are more than doubling in this fiscal year. And it will not end in 26. We expect the addressable market for Infineon for powering the AI data centers in the magnitude of 8 to 12 billion. So it's a significant idiosyncratic growth driver for the company going ahead.
How much precision do you have at the moment in terms of the outlook on that space? And in terms of being able to guide investors to what you are going to see next, how much precision do you have there?
Yeah, so first of all, the 8 to 12 is the addressable market. So it would assume 100% market share, which is probably not the most realistic assumption. 1.5 is the revenue we are generating this year. How much visibility is there? Of course, we have a very broad coverage of all major customers, be it cloud providers, be it processor makers, which gives us a great visibility into the business. You're also maybe aware that we entered into an agreement with Nvidia to cooperate on the development of a total new architecture, which is 800 volt DC-DC. So there's a lot of visibility in what's happening, but of course it is and remains a very dynamic market.
Let's talk about what else we're seeing in 2026. You have, over the last few years, been, let's call it conservative in your guidance for what the further year is going to look like. Are you being conservative when you talk about broadly moderate revenue growth, broadly moderate growth in 2026? Are you doing the same thing again? Can I call this conservative?
Yeah, first of all, I would point out to the fact that under German corporate governance, we are not only guiding for a fiscal quarter, but for the full fiscal year. Secondly, if we look back into the way we have guided last fiscal year, we called it a qualitative comparable guidance. We managed well. So the guidance we gave in November, exactly 1 year ago, matched the real numbers pretty well, despite the fact that we have to digest a significant negative currency development. And from a philosophy, how we guide, we are not changing that for that fiscal year. But it is, if you go one layer deeper, there is a story of two tales. There is the idiosyncratic growth, the boom in AI power. On the other hand, as you asked in your question, Guy, there is on the automotive, the industrial, the consumer, there is some modest growth. And why is that only modest? Yeah, it is driven by this geopolitical uncertainty, by all the tariff discussions, which lead our customers to a very cautious behavior. They are ordering on very short notice. Therefore, we have baked all that into our guidance for that fiscal year.
Do you anticipate that instability caused by tariffs and geopolitical issues will remain a factor in 2026? Is this the new normal?
Unfortunately, I believe there is some of it will be the new normal. But on the other hand, the more trade agreements we have, the more settlements we have, the more the supply chains and the companies are reacting to that, the more stability we also should get based on existing tariff schemes.
Well, that was Infineon's CFO, Sven Schneider, speaking with Bloomberg's Guy Johnson. Coming up, Nvidia's closest rival, AMD, is betting big on AI, staying with the AI theme, forecasting annual revenue growth to surge to more than 35%. We're going to take a closer look at what is fueling the chipmaker's bold outlook. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Nvidia's closest rival, AMD, expects revenue to grow around 35% annually over the next 5 years, fueled by soaring demand for data center chips. Let's get more from Bloomberg's Sven Teitel, because, of course, the market read across was there. We've got AMD, we've got Honhai, we've got CoreWeave to tie into all of this. So the data centers, the chip maker, and, of course, the equipment maker as well. Let's start with AMD and the pretty bright picture that's painted by Lisa Su, the CEO, yesterday.
Yeah, pretty bright picture when it comes to their medium to long-term view, their 3 to 5 year view on when it comes to revenue growth. She was very positive when it came to this demand for data center growth. Some people have been saying that could be something that could lessen in the next few quarters. She was actually really quite bullish that it was going to stay strong and keep accelerating. They did predict, as you mentioned, 35% revenue growth over the next 3 to 5 years. A lot of that down to their AI data center revenue growth. They want to target that an increase by 80% over the next 3 to 5 years over that same period. Now, we should mention this is surprising for AMD to give such a bullish outlook, given AMD has been one of the key outperformers this year. The stock has nearly doubled, up 100% year to date on the back of signing these deals with OpenAI and Oracle. The CEO was asked on whether she has confidence that OpenAI can fund this commitment that it has made to AMD. There's something she was asked when they signed the deal a few months ago. She commented there's plenty amount of funding available, and that the deal with OpenAI was structured in a very disciplined way. So still trying to calm investors that OpenAI does have the capacity to fund these deals that has announced in the last few months.
So on a different part of the infrastructure story and the hardware story when it comes to AI, Honhai, which used to all be about the iPhone, but now it seems is all about AI hardware and kit that goes into data centers. A pretty bright picture there in terms of the earnings as well from Honhai.
Yeah, bright picture. The closing ties with Nvidia is really why we're watching this stock closely. Or solid earnings, a beat when it comes to net earnings. And again, their demand for assembly and AI servers coming in very strong, again into double digits. It's been at double digits, frankly, frankly, for the last year. They project that to continue. So for the month of October, their AI server sales were around 11%. In the fourth quarter, they're actually projecting them to be 15%. So again, seeing strong demand. The questions now is whether the supply chain, the broader supply chain, can really meet this kind of insatiable demand.
Yeah, and CoreWeave, an example of a fly in the ointment, potentially, on that question, in terms of actually meeting the supply, or at least the demand that is there with the snafus around CoreWeave. Bloomberg's Van Hotel, thank you very much indeed for that update. We'll get a lot more coming up. Stay with us. This is Bloomberg. All right, welcome back. So we have a move in terms of bets around the Fed cutting in December. Around 67% chance of that the last time I checked on the jobs data that crossed overnight stateside. Private data, of course, we're still waiting for the official data if and when that shutdown finally closes and ends in the US and we get that official data. But you did see a move into Treasuries and you did see increased bets then that the Fed will have to go in December. But we know that decision process is pretty split across the FOMC right now. This is a picture in terms of the yield story, the moves lower that we've seen on the benchmark US 10-year. That's the white line. And the blue line is the US 1-year forward, 1-year overnight index swap that is also showing that pricing reflected as well. Let's flip the board and have a look at a very different story. We've been focused on what's happening in terms of AMD and Honhai and CoreWeave in the last 24 hours or so. But in terms of the CapEx spend and the depreciation of some of these assets on the concerns about the spend around AI infrastructure, Cameron Crees with the Gate piece today, $100 billion in terms of CapEx estimate, net CapEx, that's net CapEx for the first time ever in the third quarter. The depreciation of these assets, and Cameron Crees putting a question mark over whether or not, in fact, in terms of the history of this, that is looking comfortable for some of these hyperscalers. Michael Burry putting that short position as well, all part of the story. The opening trade is up next. This is Bloomberg.